take a step back, I think we can describe it. We're in an economic decelerating environment that might or may not go into a full recession. I think on the current track, we are likely headed towards one. But I would just caution against saying a recession is sure. I think what we can say for sure in the data currently is that we're in a decelerating economic environment. There is significant price risk over the next 12 months. And so if you look back historically, we can even put the question of recession aside and just look at economic acceleration or deceleration, because not all decelerations result in an outright recession. And so over the past decade, for example, you can measure it in the Purchasing Managers Index, which is basically a measure of economic activity. And it looks kind of like a sine wave that goes up and down every 3 years. And some of those downturns result in recessions, and other ones result in, say, near recessions. They almost cause a recession, but there's some sort of monetary policy pivot or fiscal stimulus that kind of reflates it from there. And so historically, Bitcoin has generally done very good in rising PMI environments. So economic acceleration, liquidity is flowing, most risk assets do well, and something with a lot of volatility like Bitcoin generally does even better. Then, of course, many of the altcoins, they skyrocket. And then when you have the declining PMI environment, altcoins get killed, Bitcoin suffers, stocks in general, especially riskier ones, overvalued ones tend to suffer, whereas things like cash, defensive value stocks, gold, those sort of assets generally hold up better. And right now, we're kind of firmly in the middle of a declining PMI environment. What makes this one so challenging is that because inflation's high, the Fed is trying their best to tighten monetary policy into a weakening environment. They're purposely trying to reduce demand and basically cause a near recession. And I think that's not going to go well for them. I think they're going to have to reverse at some point. But until you get that reversal, I think we are in rather risky territory. So especially if I was trading any sort of leverage, I'd be super careful. And then even unlevered, people just have to make sure that they have the right amount of exposure for whatever volatility they can afford. So I would never recommend that someone put 100% of their portfolio in Bitcoin and things like that. I just think, whatever allocation you want to it based on your education on the asset, your conviction, what you think it's going to be worth in 5-10 years, you can have that allocation. And I think you have to be willing to withstand a lot of price turbulence over the next 12 months, or at least until we see some sort of reversal from these current conditions, which is economic deceleration combined with monetary tightening, which is, pretty much anything other than cash and defensive value things are going to have a rough time there. If you see a reversal of Fed tightening, so you have more liquidity in the market, but say you still have that combined with inflationary pressures on company margins, that could be an environment where stocks, they might not do that well, whereas commodities, including gold and Bitcoin, could do pretty well because they're benefiting from liquidity without having to worry about margin pressure. They don't have employees, they don't have margins. They're just these scarce assets. So that could certainly result in a decoupling. Another one would be that even though the two types of holders have kind of come together, they're still not completely the same. It's not the same people all own Bitcoin and NASDAQ. And so, for example, a lot of people are dollar cost averaging in a Bitcoin and they're not buying the NASDAQ. And eventually you can dry up all of the liquidity, basically exhaust all the sellers, and then get a reversal. I think you're most likely to see that when you have more liquidity in the market and when you have a rising PMI environment. Take a step back, I think we can describe it. We're in an economic decelerating environment that might or may not go into a full recession. I think on the current track, we are likely headed towards one. But I would just caution against saying a recession is sure. I think what we can say for sure in the data currently is that we're in a decelerating economic environment. So that's number one. Number two, if we talk about the average person, that can vary tremendously based on what country you're in. Basically the reason why when the economy goes down and the Fed tightens, the reason why dollars pretty much go up compared to almost everything else is because that's the unit that debt is denominated in. And you're basically tightening everyone's debts relative to their assets. And so everything that's basically denominated in dollars, struggles. And so in that type of environment, if you're in the United States or other developed countries, holding a larger than normal cash position can help you get through that kind of turbulence. And then you can deploy it when you see some sort of pivot. You can get into whatever risk assets you prefer. Whereas if you're in a periphery market, if you're in a market that's suffering currency problems, whether it's Argentina or Turkey and things like that, those hard assets are still working better for you than owning your local currency. It doesn't mean every single week or every single month, but if you look at a long-term chart of, say, Bitcoin priced in Turkish lira, there's no doubt that it's a good inflation hedge. Same thing for gold, or same thing if you hold dollar stable coins, things like that. So I think the way that people can interact with this depends on where they are in the world, what their liabilities are denominated in, and what they're kind of experiencing in their local markets. And another way to phrase this is that right now we have a lot of scarcity in things that we want, especially energy. Energy is scarce, and then because that's the master resource, that affects food scarcity and all these other things. And the Fed can't print more oil. They can't print more ships and ports. They can't print more wheat. All they can try to do is try to reduce the demand for those things. That's the way that they can try to deal with inflation. But reducing demand is basically synonymous with a recession. That's what a recession is, basically a reduction in economic activity. And so in their minds, they're trying to do just a small one, right? Just trying to take the edge off demand without causing an outright recession. Historically, the odds of doing that are very low, right? So it's like being a little bit pregnant, right? The Fed has a bad track record of being a little bit pregnant. It's either they fuel recession or they don't, and at least more often than not. And so they're kind of on the track now. They're trying to curtail demand, and so that challenges people in different ways. Inflation's a challenge for people, and then also when the Fed is purposely trying to reduce demand, that's also challenging for people. So I think right now it's kind of, you want to buckle down, you want to make sure you have access to the supplies you need, and you want to be defensive, whatever that means for your personal situation. There's no single person responsible for it. It's the accumulation of moderately bad decisions over decades until it becomes a severely bad situation. And so basically, every time we have a downturn, right? So decades ago, if you have a downturn, you could just let it play out. Let the bad leverage go away, let it play out. They chose not to do that. They chose to inflate the next bubble and basically, convince people to take on even more debt. And the problem is you eventually blow such a big bubble that you can never retract it. It basically would crash even the government bond market if it were to contract. And so their pretty much only way out there is to inflate it away. They have to hold interest below the inflation rate, and you can't kind of deleverage enough debt nominally. So you have to basically increase the denominator, which is currency units, until you quote unquote fix the problem. And of course, that's a very uncomfortable situation for most market participants. And I think that's the stage of the cycle we're in, although there can be kind of, intermediate term pushbacks, right? So right now they don't want to admit that's what they're doing. So they're like, hey, we're going to tighten policy. And I think what's going to happen is the economy is going to weaken enough that they're going to have to stop tightening. And then, inflation is still high and they have to pivot, and then they're kind of out of excuses. So I think that the problem now is the accumulation of moderately bad decisions.